Every single night, well after you've gone to sleep and the local bank branches in your neighborhood have locked their doors, this massive multi-billion-dollar scramble begins.
Oh, yeah. It really is a scramble.
Right. It's this completely invisible, frantic reshuffling of cash happening entirely behind the scenes. And the crazy thing is, the price tag attached to that nightly scramble, that is what dictates the price of your car, the interest on your house, and, the trajectory of the entire global economy.
It absolutely does.
We are looking at the federal funds rate today.
Honestly, it's the single most powerful behind-the-scenes lever in the financial world. Pretty much everything else you see in the market is just a downstream reaction to this one specific mechanism.
Exactly. So today's mission is based on a really detailed excerpt from our source material. It's titled The Federal Funds Rate, Mechanics, Influence, and Economic Impact. And the goal for you today, as you're listening, is to basically demystify what this rate actually is.
Because it sounds so academic, right?
Yeah, totally. But we're going to look at why a tiny, fractional mathematical adjustment to this rate warrants breaking news coverage and, most importantly, exactly how the mechanics of it either drain or save your wallet.
Which is why this is the ultimate shortcut to being financially well-informed. I mean, people see those big headlines all the time, right? They see mortgage rates fluctuating, or they watch the stock market just surge in response to breaking news.
Right, like a massive rally.
Yeah, exactly. But they rarely understand the fundamental plumbing of the financial system that actually forces those numbers to move in the first place. What's fascinating here is that this massive economic driver all starts with something incredibly mundane.
Just banks doing bank things.
Right. It literally starts with commercial banks simply lending cash to one another overnight.
Which, sounds so small scale when you frame it like that. Just overnight loans. But to really understand how this impacts the whole economy, we have to kind of guide this conversation from those macro headlines down to the micro reality of what happens when a bank closes its doors. And from our vantage point today in June 2026, we actually have a benefit of hindsight. We can look back at some major defining shifts in recent history, like that highly publicized rate cut back on December 18th, 2024.
Oh, that was a huge moment.
Yeah. When they dropped the target range down to 4.25 to 4.50%, looking back at that pivot provides just the absolute perfect lens to understand the literal mechanical definition of this rate.
So let's actually get into the mechanics of that nightly scramble you mentioned. The baseline reality here is dictated by strict legal reserve requirements.
Okay.
By law, commercial banks are required to maintain a specific percentage of their total deposits in an interest-bearing account at a Federal Reserve Bank.
So they aren't just sitting on huge vaults of physical cash hoping they have enough for the day.
Right, no. It's a highly calculated, heavily regulated pool of money to ensure stability. And that stability is measured on a rolling basis. Regulators look at a 2-week average of the bank's end-of-the-day balances to determine if they are actually meeting those legal reserve requirements. But, deposit levels fluctuate constantly.
Sure, because you deposit a paycheck or a business withdraws payroll.
Exactly. A massive corporation moves millions to a different account.
Mm-hmm.
So at the end of any given day, a bank might look at its ledger and realize, uh-oh, it has a shortfall.
They come up short.
Right. It doesn't have enough in reserve to meet that legal mandate.
Yeah.
Or, conversely, it might have excess reserves just sitting there doing nothing.
And that dynamic is what creates a market. Because if a bank has excess reserves, they can lend those extra funds to a bank facing a shortfall. They lend it overnight. And crucially, our source points out this is done on an uncollateralized basis.
That's a really key term.
Yeah, meaning the borrowing bank isn't putting up an asset to back the loan, right? It's just cash for cash, based entirely on trust between these massive financial institutions.
Exactly. And the interest rate that the lending bank charges the borrowing bank for that quick, uncollateralized overnight loan, that is the federal funds rate.
Okay, let's unpack this just to make sure the practical application is crystal clear. Think of it like a massive chain of franchise restaurants.
Okay, I like this.
Imagine corporate policy dictates that at the end of every night, every single cash register in the city must have exactly $500 in change before the managers can lock the doors.
Right.
Now, Restaurant A had a weird day. Maybe a lot of people paid in cash, and they end up with $700 in the register. But Restaurant B had a huge run on quarters, and they only have $300.
So they're short.
Right. So to avoid failing the corporate inspection, Restaurant A simply lends Restaurant B the extra $200 overnight. And just for the favor, Restaurant A charges Restaurant B a tiny fee.
That is a perfect analogy,
Yeah.
and the scale of that dynamic is just staggering because we are talking about hundreds of billions of dollars moving around the banking system every single night. And the whole reason this strict rule exists is to prevent bank runs. It ensures that financial institutions always have enough money on hand to cover depositor withdrawals and, their immediate obligations.
It basically keeps the systemic plumbing from freezing up.
Exactly. And there is a crucial distinction from the source material to highlight here, just to clear up some common
Oh,
confusion.
yeah, go for it.
The federal funds rate is strictly the rate at which commercial banks borrow and lend their excess reserves to each other on the open market. It is bank to bank.
Right.
This is entirely different from the discount rate. The discount rate is the interest rate banks pay when they bypass each other completely and borrow directly from the Federal Reserve itself.
Got it. So it's a completely different avenue. So
Yeah.
once that thermostat is adjusted, like, say, banks are suddenly paying more for their overnight loans, who takes the hit the next morning?
Well, it trickles down.
Right, because commercial banks aren't just going to quietly absorb that extra cost out of the goodness of their hearts. If banks rely on this nightly bank-to-bank lending just to function, whoever dictates the baseline cost of that lending effectively holds the reins to the entire economy.
Well, absolutely.
The cost of that overnight loan ultimately bleeds into everything, which naturally leads us to the decision makers, the actual conductors of the economy.
The Federal Open Market Committee,
Yeah.
FOMC.
Yes. According to our source, this policymaking body of the Fed meets 8 times a year to set a target range for this rate.
Not just a single fixed number, right?
Right, a range. Like that December 2024 cut to a range of 4.25 to 4.50%. And they make these decisions by looking at highly specific economic indicators, things like the core inflation rate or the durable goods orders report, just to gauge the overall health of the country.
And the logic there is essentially the foundation of modern monetary policy.
Hmm.
Lowering the rate makes borrowing cheaper across the board.
Right.
That stimulates economic growth. It encourages companies to expand. It incentivizes consumers to take on debt to buy things. And it helps prevent unemployment from rising.
It gets things moving.
Exactly.
Yeah.
But if the economy is overheating and inflation is getting completely out of control, they raise the target rate. That makes borrowing expensive, which encourages saving and cools everything back down.
But here's where it gets really interesting, though. If this federal funds rate is just this organic rate that commercial banks are charging each other on the open market, how can a committee of people sitting in a room 8 times a year actually enforce a target range?
That's the big question.
Yeah, I mean, they can't just mandate what JP Morgan charges Bank of America, right? It's supposed to be a free market.
Right. They don't just decree it. They enforce it by actually manipulating the supply of money itself. The source text points out that the FOMC uses various tools to literally push the effective federal funds rate into that desired target range. And their primary tool is called open market operations.
Which means they are actively participating in the market to force the outcome they want. It is kind of like a thermostat in a house, right?
Yeah.
FOMC is setting the thermostat on the wall to 72 degrees,
Right.
but just adjusting the dial doesn't magically change the air. The FOMC has to actively trigger the AC or kick on the heater to force the actual temperature of the room to match their target.
That's exactly it.
So what is the actual AC and heater in this financial scenario?
Government bonds, specifically Treasury securities. If the FOMC wants to lower the federal funds rate, they go in and buy government bonds from commercial banks.
Okay.
By purchasing those bonds, the Federal Reserve essentially creates money and deposits it directly into the bank's reserve accounts. So suddenly, banks are flush with excess cash, supply goes way up.
Gotcha.
And when there is a massive supply of excess reserves, the cost to borrow those reserves overnight plummets.
Because everyone has cash to lend, so they basically have to offer a cheaper rate to attract a borrower. It's just supply and demand.
Exactly. And the reverse is true when they want to raise the rate. The Fed sells government bonds back to the banks, taking cash out of the bank's reserves to pay for them. The pool of available cash shrinks. Supply goes down, demand goes up, and banks are forced to charge each other higher interest rates for those overnight loans.
Wow, so they're literally just tweaking the supply pool.
Yes. If we connect this to the bigger picture, your thermostat analogy really captures the high-stakes balancing act the FOMC performs. They're constantly reading the room, monitoring inflation and durable goods, and using these open market operations to prevent a recession on one hand, while curbing runaway inflation on the other.
Now that we understand exactly how the FOMC buys and sells bonds to adjust the temperature of the economy, it's pretty fascinating to look back at times when the temperature in the room reached absolute extremes.
Oh, history gives us a wild roller coaster of numbers here.
Yeah, it really does. Our source outlines that standard adjustments by the FOMC are usually pretty small, just like 25 basis points.
0.25%.
Right. But when dramatic action is needed, they will move it by 50 basis points or more. Looking back at the early 1980s, the rate hit a staggering 20%. Just let that sink in. To combat sky-high inflation, the overnight rate for banks was 20%.
The psychological and economic reality of a 20% federal funds rate is honestly hard to overstate.
Yeah.
It meant that borrowing money was just prohibitively expensive.
Nobody could afford it.
Right. Businesses couldn't afford to take out loans for basic inventory. Everyday consumers couldn't afford mortgages. And economic expansion effectively hit a brick wall. It was a brutal, intentional deep freeze designed to kill inflation at absolutely all costs.
And then you flip the script to the complete other extreme. After the 2008 Great Recession, the FOMC slashed the rate to a record low target of 0 to 0.25%. They effectively hit the floor, the zero lower bound. And they did the exact same thing again in March 2020 at the onset of the pandemic.
Which introduces a completely different kind of crisis for the Fed. When the target range is at 0%, your thermostat is essentially broken.
You can't go any lower.
Exactly. You cannot lower the rate any further to stimulate the economy through traditional overnight lending. Money is essentially free at that point. This forces the central bank to rely on unconventional, massive-scale interventions, things like quantitative easing, just to keep the financial system breathing.
Which brings us right up to the recent cycle. From 2022 to 2024, they were aggressively raising the rate back up to combat a massive spike in inflation.
Right.
And then we hit that major news event we mentioned earlier, December 18th, 2024. For the first time in over 4 years, they finally cut it. They dropped it by just 25 basis points to that 4.25 to 4.50% range.
Yeah, and that was to signal a shift, a move to bolster the broader economy and prevent unemployment from sliding too far.
And this is kind of the crux of the issue, right? When you compare a massive 20% rate in the 1980s to the emergency near zero rates of 2020, a 25 basis point change seems like a rounding error.
It does seem tiny in comparison.
So why does a mere 0.25% cut in December 2024 make national headlines? Like, why do global markets obsess over such a small mathematical tweak?
Because it is entirely about momentum and signaling. It isn't just the isolated math of the 0.25%. It's the message it sends to the world about the future. Investors, trading algorithms, corporations, they monitor these basis points obsessively.
Every single word they say.
Oh, absolutely. They parse every single statement made by FOMC members, searching for any tiny clue about the trajectory of that target rate.
Because it reveals what the Fed's internal data says about the actual health of the country.
Exactly. When the Fed cuts the rate after 4 brutal years of raising it, it completely alters the psychological behavior of the entire financial ecosystem. The market realizes the era of tightening is over, and the era of loosening is beginning.
The tide is turning.
Right. That 25 basis point shift tells every investor and bank on Earth that the wind has changed direction, which prompts them to instantly reprice trillions of dollars in assets.
And because that tiny shift changes the psychological and mathematical behavior of those massive financial markets, it cascades down to the daily life of the listener tuning in right now. Let's trace that ripple effect. We established earlier that the federal funds rate is technically just for banks lending to banks overnight. But our source highlights that this rate indirectly influences what is called the prime lending rate.
Yes. The prime rate is the interest rate that banks charge their absolute best, most creditworthy corporate customers. It basically serves as the baseline, the core foundation for almost all consumer lending.
And here is the causal link. If open market operations force the overnight rate up, it costs Chase, Wells Fargo, and Bank of America more to meet their legal reserve requirements.
Right, their expenses go up.
Right. Their overall cost of doing business increases. And they are not going to simply absorb that extra overhead and shrink their profit margins. To compensate, they immediately raise the prime rate. They pass the cost on to their corporate clients and eventually to you. The source lists some very specific sectors that take the hit. The automotive industry is a really huge one.
Oh, massive. Car dealerships finance their lots of inventory through what is called floor plan financing, which is often tied directly to the prime rate.
Okay.
So when the prime rate goes up, the dealer's overhead spikes. They pass that cost on to the consumer through higher auto loan rates. Suddenly, The monthly payment on a standard, everyday sedan is hundreds of dollars more expensive.
Which means fewer people can buy cars.
Exactly. That dictates how many vehicles are sold in a given year, which then affects manufacturing jobs, factory output, and ultimately dealership profits.
And then there is consumer lending. I mean, if you have a credit card or a personal loan, those rates are heavily directly influenced by the federal funds rate.
Oh, for sure.
If you're carrying a balance, a rate hike means way more of your monthly payment goes to interest rather than paying down the principal. Government finance is also affected. The rate influences the cost of government borrowing.
Right.
When the Treasury issues bonds to fund operations, higher rates mean the government pays more in interest, directly impacting national budget deficits and tax policies.
It even dictates foreign exchange. This is a massive global factor. Changes in the federal funds rate can significantly alter the value of the U.S. dollar relative to other currencies.
Oh, wow, really?
Yeah. When the U.S. raises rates, it offers a higher return on safe haven investments like Treasury bonds. So foreign capital floods into the United States to chase those yields.
That makes sense.
And investors have to buy U.S. dollars to buy those bonds, which drives up the value of the dollar itself. A strong dollar makes imports cheaper for U.S. consumers, but it makes U.S. exports way more expensive for the rest of the world, impacting international trade and global corporate earnings.
Not to mention domestic corporate investments. If a company wants to build a new factory, upgrade their software infrastructure, or hire 1,000 new employees, they usually have to finance that expansion.
Exactly.
Lower rates spur that expansion because borrowing the capital is cheap. Higher rates curb it, forcing companies to pull back, delay projects, and sometimes lay off workers. And of course, the big one, real estate.
Yeah, mortgage rates are deeply sensitive to these shifts. While they don't mirror the federal funds rate perfectly on a one-to-one basis, the trajectory of the overnight rate dictates the broader bond market, which then drives the 30-year fixed mortgage. It dictates whether you can afford to buy a house, or whether it even makes financial sense to refinance your current one.
So if you are out there right now trying to secure a mortgage, negotiating a car loan, or carrying a balance on a credit card, that invisible overnight bank drama we talked about at the very beginning is exactly what is draining your wallet or saving you money.
It is a masterclass in interconnected systems. When a lower rate is announced, you will often see the stock market immediately leap higher. The borrowing costs for corporations just got lower, which means their future profit margins just got wider, which means their stock is suddenly inherently more valuable.
It's all connected.
It is. Conversely, higher rates compress those margins and the market pulls back. This raises an important question for anyone listening. If you look back over the last few years, through the zero-rate era of 2020, the high rate hikes of 2023, and the shifting tides of late 2024 and beyond, how have your own spending, borrowing, or saving habits shifted in response to those environments?
It really makes you evaluate your own financial timeline. We have covered a massive amount of ground today.
We really have.
We started with the literal definition, the uncollateralized overnight loans between commercial banks scrambling to meet their daily reserve requirements. We walked into the rooms of the FOMC where they meet 8 times a year to set the target range, using open market operations to manipulate the supply of cash and steer the economy. We rode the historical roller coaster from the brutal 20% rates of the 80s to the zero lower bound crisis of the pandemic to the monumental signaling of a 2024 pivot. And finally, we tracked those massive ripple effects, tracing exactly how an overnight bank cost forces the prime rate higher, touching everything from global foreign exchange all the way down to your personal auto loan.
Understanding this single benchmark rate is honestly the ultimate shortcut to being financially well-informed. The federal funds rate isn't just dry financial jargon, it is the absolute heartbeat of monetary policy.
Definitely.
By understanding the underlying mechanics of how and why it moves, you can read future economic headlines with total clarity. You'll know exactly what is happening beneath the surface and how it is going to impact your specific financial situation.
I love that. And before we go, I want to leave you with one final provocative thought to mull over on your own.
Oh, let's hear it.
We learned today that this entire machinery, the very foundation of the federal funds rate, is based on a law requiring commercial banks to maintain reserves in proportion to their deposits. The entire mechanism relies on the fact that citizens and corporations keep their cash in traditional bank accounts.
Right.
So here's the question. What happens to the Federal Reserve's control over the economy if deposits migrate out of the traditional banking system? If future generations move their money into decentralized finance, unregulated digital wallets, or alternative shadow banking platforms, the commercial bank reserve pool shrinks. Does the Federal Reserve's economic thermostat simply become disconnected from the rest of the house?
Wow. That is a fascinating systemic question. It really challenges the future viability of the tools we've relied on for decades.
Something to keep you up at night. Or at least something to think about the next time you see a breaking news headline about the Fed making a 25 basis point move. Thank you so much for joining us on this deep dive into the invisible machinery of our economy.
Keep exploring the mechanics behind the headlines. It has been a pleasure.
And as requested by our source text today, if you found this breakdown helpful, be sure to follow us on Spotify. Open the full version, hit follow, and consider subscribing for more quick tips and updates. Thank you for your support, and we will catch you on the next deep dive.